So what is the cost of rolling too soon? Welcome back, options traders. And I just had a conversation with another trader through email about this very topic. And it's one that when people first learn about rolling, they get carried away with it. Yes, we all love our rolls. We know that it's one of the more powerful aspects of options. You can't do it with futures contracts. You can't do it with shares of stock, but you can certainly roll your options. And when we do that, we get cash off the table, we limit our risk, but we still are able to hang on for higher profits. But like anything else, too much of a good thing can actually be bad. So you can't just use the logic of saying that if rolling is good, let me do it all the time. That's like saying if one aspirin is good, 5 must be better. There comes a point where you can roll too much. But why is that? What is the cost of rolling too soon? Well, let's go find out. And before we do, as always, please click like and subscribe. It is definitely very much appreciated and helps to promote the channel. So first off, remember what rolling is. As a basic rule, we are going to roll our call options up and roll our put options down. So for example, let's say that you buy a $100 call, you spend $5 for it, and at a later time, the stock goes up. It's moving in your favor, and you're able to now sell this $100 call and simultaneously buy the 105 call. And let's say that it's trading for a net credit of 4. So this trade, selling the 100 call and buying the 105, is a vertical spread. That's the way that you would enter it into your broker's platform. You would sell the 100-105 vertical spread for a credit of 4. And what that does is it reduces your max loss by that credit. You've now swept $4 right out of the position and put it right into your account, locked up, tight. It cannot be lost. The problem is that it also increases your break-even point, in this case by 1. And the thing to observe is that the amount that you're reducing your max loss by, in this case 4, plus the break-even increase, has to add up to the difference in strikes. And notice in this example, I have made a big reduction to the maximum loss by 4, and I've only pushed out the break-even point a little bit, relatively speaking, by $1. So for example, let's start with our $100 call here at 5, but let's say that we roll for only $1 credit. We're going to shift from the blue to the orange. Notice that we didn't really lift this maximum loss all that much, but we did push the break-even point out quite a bit further. Look at how much further this orange line sits below the blue. And now the stock rises some more, and we sell the 105 and buy the 110. We do this. If we sweep off another credit, we've gone from the orange to the green. Again, not a real big benefit in terms of the cash that we've received, but we have a very big damaging effect out here in the break-even. Stock rises some more, makes another big move. What happens? We're able to sweep off another credit of $1. We go from the green to the red. Okay, we've picked up another buck, but look what we did to the break-even point. So the real irony is that the stock has made a tremendous move. Remember, we started back here on the blue line with a $100 call. And now maybe the stock has gone up 15 points or more, and yet we're still underwater. Look at this. We paid 5. We now have a maximum loss of $1, and that's because we've pushed this break-even point out so far. And the real problem is that if this happens close to expiration, you were absolutely right for thinking that the stock was going to go higher. You bought the call, but because you were too fearful, you ended up locking yourself into a loss by rolling too soon. So the real irony is that you were right. You purchased the call, the stock went up. It actually went up a lot, but you have no profits at all to show for it. You paid 5, you've collected 4, you're still down $1. And that's no way to make profits. And the reason this happened is that you rolled too soon and locked yourself into a loss. So the thing that you want to remember, which I've talked about in previous videos, is this 80% rule. And the basic idea of the rule is that you should try to capture 80% of the difference in strikes. Now this usually applies more for longer term positions. If you're in something for a week or 30 days, chances are that stock is not going to make a big enough move to where you can do this. Mostly what I'm trying to show traders are easier ways to make money by looking at longer term plays. And with that in mind, an 80% rule is a pretty good idea. So if you're trying to roll from the 100 to the 105, That's a $5 difference in strikes. 80% of that difference is $4. That's where I was getting that $4 figure from. And so that's a pretty good benchmark to shoot for. But the main thing to understand is that you should not roll longer term positions for small credits. And I hear traders rolling them for 50 cents or $1, again saying, well, hey, money's money, I might as well roll it. And the problem is they're not seeing what the cost is in terms of pushing that break-even point way too far out to where you have no chance of making money. So use the 80% rule and you'll do much more efficient rolls, and that will always mean better results. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.